Hey Dave, how you doing today?
I'm doing great, Nick. I'm doing great.
Fantastic.
Winter
Winter's
storm.
back. Yeah, are you
Yeah.
snowed in up there?
We can get out. We can get out. The plow guy just came, but the sheriff in the next county over from us just asked everybody to stay inside.
Oh,
So,
wow.
hey, I like to do what I'm told.
If you're that far up north and the sheriff is telling you to stay inside, it's probably pretty bad.
Yeah, 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 yeah,
Lots going on around here at SRB, but we wanted to
yeah.
take some time and talk about what potentially could happen in 2025 and kind of give us five key insights for how to think about investing and especially retirement investors in 2025. Because there's lots of stuff going on around there, and it's a good time for
Right.
some perspective, right?
Right. Yeah. And we'll be doing our normal quarterly investment and the economic update here in a couple weeks when we get into January. But our friends at Clearnomics put together a real nice piece about five basic things to be thinking about as we roll into the new year. So,
Yeah,
yeah.
and I think starting with the recap of 2024, right? Like when we were
Hmm.
sitting here, beginning of the year, January of 2024, we started out with major market, economic, and political concerns for investors.
Yeah.
Back then we were talking about the hard landing recession, and I know we talked a little bit about that in our annual predictions episode last January. But a lot of, recession talk, a lot of market pullback talk, a lot of
Hmm.
election turmoil, really kind of making investors feel jittery in 2024. And as we look back from where we're standing right now, before the market opened today, the S&P 500 was up
Yeah.
27.56%.
Yeah.
Inflation was down, trending down. I know it ticked up a little bit at the most recent reading, but still down for the most part over the year. The economy is in kind of steady growth mode, and the Fed has started its rate cut cycle. And so, here we are.
Yeah. Yeah. Instead of this hard landing, gloom and doom, scary scenario, we're kind of in this Goldilocks situation right now where inflation is moderate and the unemployment rate is still low and gross domestic product has been clicking along all year. It just goes to show, like you said a minute ago, we're going to have our prediction episode here in a week or two, but I'm glad we don't make predictions.
I'm glad our pay isn't based on our ability to
Right,
predict, right?
right, right, right.
And just kind of summing up 2024 is a great reminder that excessive worry can really lead retirees to make some pretty poor
Yeah,
decisions that aren't necessarily going to serve their long-term interests,
yeah,
right?
yeah, yeah.
And you
So,
could almost we could almost repeat that in 2023 as well, because a lot of similar stuff
hmm
was going on in
right,
2023, and between the last 2 years the S&P is up almost 50%.
right. It's crazy. It's crazy. So yeah, that's kind of the first real insight to think about here as we roll into 2025. Um, we've had stronger than expected economic performance has led to great stock market and bond market performance. I mean,
Yeah, I was kind of
looking at the
surprised when I looked across the board of the different asset classes, and U.S., international, small caps, like you name it, they're positive.
commodities,
Commodities,
fixed
yep.
income, bonds are up, international stuff. So it's like everything rallied again this
Right.
year, and
We even have to give
that is really rare.
a shout out
Yeah,
to our man Cole with Bitcoin
uh,
hitting historic
right.
levels as well. So
Yeah,
all is good in
I'm
the investment
still not
world.
ready to call it an asset class, Nick, but but it looks pretty good if you'd made that bet earlier this year, right?
Yeah, fair
So
enough.
so
And,
that's
it's I would as I obviously we had the whole political thing, and there was a lot of people that felt that the economy maybe wasn't serving their interests, and there was a lot
hmm
of talk between the candidates about that. But when we step back and take some of the emotion out and look at like the hard numbers and data, the economy is doing pretty well as reflected with these numbers that we're
right,
talking about, right?
right, right. So the other shoe if you will,
Yeah.
to drop when we're talking about the market having like two stupendous years back to back, is that means the stock market looks expensive by historical measures,
Yeah.
and that's something to consider, for sure. The what we call the price to earnings ratio, which is basically taking stock prices and dividing them by the earnings those companies are producing. If we look at that for the S&P 500, we're at about 20, little over 22 right now. So for
Mm-hmm.
every dollar of earnings, you're paying $22 in stock price, and the historical average is 15.7, I believe.
Yeah.
Yeah. So
Yep.
that means stocks look expensive by valuation measures. Um, and one thing, that you are able to kind of look at and predict over long-term trends is when stocks are expensive, you'd expect the long-term returns to be lower than average.
Yeah, I think that's the one takeaway that we really want to focus on when we talk about PE ratios, stock valuations,
Hmm.
is that it definitely lends towards historically having lower returns over longer periods of
Right.
time, right? But most of those time frames are still positive, right?
Right.
and still, outpacing inflation. And so it's not one of those situations where you look at high PE ratios and say, let's get out of the market, right? Because
Right.
you could have made the same argument last year when it wasn't as high as it is now, but it was still well above that 15.7% average, and you would
Right.
have missed out on 20% growth this year, right? So it's not the
Right.
end all be all, but certainly in we you do capital market assumptions every year and update those, and that's one of those things in our planning software where we're saying, okay, evaluations are high, so we need to temper some of those expectations when we're running projections for people.
Right, right. But we're also not saying, okay, so for our projections, we're going to use like -3 instead of, 7. Instead of like
Right.
7, we might be using 6.5 or six and
Yeah.
a quarter,
Right.
So I think that's an important point. The other thing is what this really means to me isn't about getting out of the market. It's about being pickier about what you own and being
Mm-hmm.
diversified. Okay.
Yes.
So what we've seen in the market is the average stock may not be too expensive right now, but all of the like tech companies and things like that that have driven the rally over the last 12 to 18 months look really expensive.
Mm-hmm.
So when we build portfolios, we focus on value stocks, which is a subset of the market where PE ratios are one of the criteria, right?
Right.
So focusing on companies that have lower price to earnings ratios because they still have more upside potential.
Yep.
That's part of it. The other thing is, while everything is up this year on a relative basis, there's some pretty wide disparities. Small companies didn't do as well as large companies. International stocks didn't do as well as US stocks. So being diversified and making sure we have allocations in those things that may have done well but didn't like knock the cover off the ball for the
Mm-hmm.
last 18 months makes a difference too in how I feel about the portfolios.
Yeah, and to your point of being diversified gives you access to some things that aren't as high, don't have as high evaluations, which gives you some more upside potential, but it also kind of protects you on the downside too, right? Like
Hmm.
those
Exactly.
probably aren't going to fall as much as what the higher valuation stocks would in a
Right.
bad market.
Right. Right.
So it works
So
both ways.
so it's a insight to be cognizant of, but it's not like, okay, gosh, we've got to move all our money to cash because stocks are expensive.
Yeah, it's one of those where it's good to be aware of because you're probably going to hear it on the news media and the
Yeah.
financial, the financial media, and they're going to make it sound like it's the most important thing since
Hmm.
sliced bread of like how you should make decisions based on what PE ratios are compared to what they historically were. In reality, it does have an impact, but not as much as they would like you to believe, right?
Yeah. Yeah.
Or scare you into belief.
Yeah. Yeah.
So our third insight for 2025 is that the expectation now is for further rate cuts from the Fed.
Yeah, we've seen interest rates come down after a really quick increase cycle in 2022 to combat inflation. Now, as of July, the Fed has pivoted towards lowering interest rates, and the expectation is that will continue if inflation continues to abate.
Yeah, it's interesting because, inflation, while we have, I don't think the verdict is out on it's beaten dead and, it's just going to stay below 2% like it did like previously, right? Or at 2%.
Hmm.
As we've seen with a little bit of an uptick here in the readings from earlier this week.
Just last,
And
yeah, this last
so
week.
So I think what you'll see is, yes, the Fed is probably still going to and has said that this come out and said that they're going to continue to lower interest rates, but not in a fast paced manner by any stretch of the imagination at this point.
Yeah,
So it's kind of that balancing act, and it actually, provides opportunity for bondholders in terms of if short term rates start to come down, but longer term rates stay where they are, you still have some of that benefit of rates going down, but also still having decent yields, which we
yeah.
haven't really had in a long time, sans when the Fed, the last year or so, right?
Right. So we could potentially see some bonds increase in value and at the same time continue to produce good income streams from their interest payments,
Right.
which
Yeah.
is the way we want it.
Yeah.
Um, it's interesting too. We're gonna shift into insight number four here in a minute, but I think the two kind of go hand in hand,
Hmm.
because right now, based on what's baked into the economy right now, the expectation is that interest rates would continue to come down along with inflation over the next little while. But there's when we shift to insight number four, that now that with the election behind us, the economy can kind of shift to thinking about policy.
Yeah.
Some of those policies potentially are inflationary and could make the Fed's job harder. So,
Right.
so we'll see how this plays out. But the big questions now are: will the Republican led executive and Congress as well provide a pro growth environment, and how will that affect markets? And again, it could be good. We could see a pro growth, pro stock market kind of. Back to valuations for just a second. There's two ways valuations can get back to normal, right? You can
Right.
you can see stock prices come down or slow down, or you can see earnings go up.
Yeah.
And if earnings go up, then dividing the stock prices by a bigger number makes that valuation come back where historically would be more normal. So that's a possibility. Um, there's talk of interest rates staying lower. I'm not sorry, not interest rates, tax rates.
Hmm.
Kind of baked into some of the assumptions over the last year has been that personal income taxes would probably go up after 2025 with the current tax law expiring.
Hmm.
With the current political climate, we may see those lower rates stay lower, and that would be pro growth, but potentially also inflationary too. Because if
Right.
people have more money to spend that would have normally gone to tax, that can create some inflation. So there's that. There's concerns about tariff talks and trade disputes, and what impact that will have. There's a lot of wild cards out there.
Yeah, it's nice because the commercials and the rhetoric are over, and now what we can focus on is policy, right?
Right,
And so
right.
hopefully we're getting some answers to some of those questions. As I'm sure a lot of our listeners are aware, sometimes you say things to get elected, and those things don't always necessarily come true.
True.
And so now we can focus on whether or not those things are going to come true and how that impacts the economy, both from a personal financial standpoint, like you talked about, Dave, with the personal tax rates and how that impacts financial planning, but also
Hmm.
corporate taxes and other policies such as trade wars, tariffs, budget deficits. All that stuff comes back
Yeah.
into focus now, and
Yeah.
and now we see what our elected officials will decide to handle those, and what kind of potential
Yeah.
ramifications that'll have for the markets and the economy.
There's going to be some pretty interesting debates around topics such as tax and trade here over the next 12 months for sure. And while there's Republican control, it's a pretty narrow margin in some respects.
Mm-hmm.
So, just thinking that what they talked about during the campaign is what's going to happen is it's going to be more nuanced than that. So,
Yeah. Not only is it a
we'll see.
narrow margin, but also, as we've seen in the past, they have a hard time seeming to come together as a core group because there's a lot
Right.
of in-party fighting going on. So
Right.
time will tell. But I think the biggest thing to focus on here as well is that what matters much more than our elected officials, which is good news for those of us who kind of have some concern about what Congress does and doesn't do. Business cycles matter much more than who's in Congress, who's in the White House, and so that's
Yeah.
really what to focus on and what will ultimately drive the long-term trajectory of markets. And so not all is lost, depending on how you feel about our elected
Right.
officials and what that
Right.
means for the short and long term.
Right. Right. And um, yeah, it's going to be an interesting debate, particularly around tax policy. So,
Yeah,
all
definitely
right,
foreshadowing to some of the things that we're going to be talking about in 2025
for
is
sure.
taxes, tax changes, how to do some tax planning in 2025, and how this all plays out when it comes to
Hmm.
what the new potential tax law may be.
Yeah.
Um, Number five, I think, is the most important thing for us to focus on here, and that is that long-term thinking will be the key to success, not only in
Yeah.
2025 but beyond. Right?
This to me is like a standing insight that everybody needs to be reminded of every quarter, if not daily. We're not really, we want to talk about what's going on and we want to make sure clients understand it and are being thoughtful about their portfolios. But what happens in 2025 isn't really going to be that important in the greater scheme of things.
Yeah. And
It's
I
it's
love this chart. We'll throw it in the show notes, but it's the growth of a dollar. There's several
hmm
iterations of this, but the growth of a dollar since 1926, just kind of going through like all the terrible things that have happened to the US, right? So we've got the
yeah.
crash of 1929, we got world wars, we got Vietnam wars, we got stagflation, Black Monday, tech bubble. This is just scratching the surface of some of the things, the
Right,
housing bubble, the
just the
financial
big ones.
crisis.
Yeah.
And yet, if you stayed invested, you would have turned a dollar into $18,000 over that time frame,
Right.
investing in the
And
U.S. market.
and
Right. So
and
that's
what
the
would
perspective we want to take.
and compare that to $111 if you had invested in 10-year treasury bonds over that whole
Right. Yeah.
period. So,
It's
yeah,
pretty remarkable.
it is.
And that
It is.
is
It's
focusing on
astounding.
the right things, which is the long term. Yes, these things are going to come up, and yes, you don't want to necessarily ignore them. Although, history has shown us that ignoring them tends to favor the investor. But you don't want to overreact to them, right? You don't want to let your emotions get
Exactly.
involved. You want to be invested for the long term and planning for the long term, because what happens in the here and now doesn't always affect what the long term looks like.
You know
And
it, Nick.
if nothing else, the biggest lesson of 2024 might be that markets can perform well despite investor fears and jitters and all the things that are potentially going on. Right, that's another
Yeah.
thing to kind of remember. Markets were really resilient in 2024. We had good economic growth. We had lots of innovation and positive trends across many asset classes. And we wouldn't have predicted that. I don't think we did predict that,
We did not.
starting out in 2024.
We did not.
And so that's
We're in
why
good
it's kind
company
of
though.
why we do predictions, is because we know that
Right.
they're probably not going to come true. Right? It's tongue
That's
in
right.
cheek of it is meaningless what you think will happen in the
Yeah.
short run. So
Yeah. So Good things to
Yeah.
think about.
As always, we're hoping that 2025 is a great year, but if nothing else, let's focus on the long term and not necessarily get caught up in what might happen in the short run. So,
You
if
bet.
there's nothing else you take away from this episode, definitely take that away, right?
Yep.
So, with that, cheers to you, Dave, and happy new year. And we will be back with another episode, hopefully next week, and then rolling into season 4 in 2025 with our vaunted prediction episode coming in
There you
January.
go.
So, look forward to
Yep.
that one as well.
Yep. Get out your scorecards.
Yeah. Thanks,
All
Dave.
right.
Been a
All
pleasure.
right. Take it easy. Thanks.
Bye.
This is a Zedia Media production.